Okay, we're going to get started. Dan, you ready?
I'm ready.
Okay, so welcome to our March 2026 podcast. And I think for today's podcast, Dan, we're kind of throwing out the script. Literally last week, I was putting some stuff in front of Dan on different items we might look at. And this is Thursday before the Iranian strike. And you said, hey, we're probably going to have to talk about this Iranian issue on Monday. So just to timestamp it, we are recording this podcast at about 11:15 a.m. on Monday, March 2nd. So, and it looks like the markets are just open, reacting to the news, and it's pretty much been flattish today. It was down the worst I saw for the Dow was it was down about 540, I think, this morning.
Yeah.
And now, as we speak here, it's down about 150 points. So pretty muted reaction. And we know from history, Dan, that the markets, what they really hate is the unexpected. And if you looked at the movement of military assets over the last couple of weeks, this was hardly unexpected. And if you look at it even from Iran's side, I mean, their supreme leader was, 86 years old. So they probably had been thinking about maybe not losing 40 of their leaders, but at least some kind of contingency plan if he were not in place, right? So, and we've seen it before, and I know, Dan, you looked at some of the historic events. Probably the biggest thing is that to give this a couple days before we can react and figure out what the ramifications are. We're going to plan, I think we should on Friday, maybe do a webinar. So we're Monday, we'll do a webinar on Friday, kind of take a look at how the economy and the stock market are reacting. That's our job. But it is, probably the biggest thing we're nervous about is it could be a little bit of an oil shock. If you look at Venezuela, they had produced, we're worried about Venezuela, but they produced about 800,000 barrels a day, which is, that's way off their peak. I think they were over 3.5 billion barrels a day in the 90s. But when you look at Iran, I think it's more of a bottleneck story there, because I think as of this morning so far, last night, the Strait of Hormuz is still closed. So there's not oil flow going through. And I think that's about 13 million barrels a day goes through there.
It's
right?
about 20% of the world's oil supply and liquefied natural gas supply. So that was an escalatory step. I think one of the surprising things outside of the weekend was, certainly expected a heavy Iranian response and bombing of U.S. military bases and things like that. I think what was a little bit more surprising is that they also tied those up with civilian infrastructure strikes across the region, and the fact that they really pretty much no one was spared. Right, every major regime in the Middle East saw some blowback from this operation, and then they've been threatening for years to close the Strait of Hormuz. That was, I think, historically viewed as kind of their key piece of leverage. So the fact that they're playing that on, day 2 of the conflict, and now we're, into day 3 here, that was probably a faster escalation than I think maybe they initially had anticipated. Now, for the U.S. markets, thinking about the oil supply and energy independence, it's less important from a U.S. sustainability standpoint, but I think one of the interesting things to see will be if the strait remains closed for an extended period of time, China and Japan will be majorly impacted by this. And you could start to see.
Because that's where that oil is going.
Correct.
It's all going to Asia.
Correct.
Right? So it's going to impact China and India.
So that's something to absolutely watch.
Right.
And I wouldn't be surprised if you see oil, easily move towards $100 a barrel mark. The degree to which that's a sustained move, we'll see on how quickly this wraps up. But yeah, I think in some ways, the uncertainty, we may see that trend kind of sneak back into the market over the coming days. Right now, it's a little bit of a positive reaction, but if this, prolongs and escalates further, I think you could see some pain.
Yeah, it seems like it was not a surprise, but the severity was a surprise that we hit, something like a 1,000 different targets in Iran, much bigger than we were talking about last week. And I think you're right. The response by Iran, hitting, some countries that they had a pretty good relationship that have been somewhat, if you can call it neutral, was also a surprise.
When you think about, in Dubai, for example, I mean, hitting
Hotels, yeah,
hotels
right.
and the world's largest airport, right? So you're talking about disruptions in terms of airspace and flights in the Middle East, and that could be for weeks. So,
Right.
the knock-on economic impact of this is not yet determined. But I kind of wanted to put some of this in context, looking at some major geopolitical disruptions and wars over the past handful of years, and even going back as far to say Pearl Harbor, and just looking at like
Hmm.
initial drawdowns versus recovery periods. Obviously Pearl Harbor was the most extreme. You had almost a 20% initial drawdown.
Hmm.
Took roughly
Okay.
307 days to recover. So
Right.
almost a
Right.
year
Sure.
from that initial drawdown. Um, Gulf War going back to the 1990s, 13% drawdown, 189 days to recover. 9/11, 12% drawdown, 31 days to recover.
And then we had a market completely closed
Closed
post
during that period of
9/11, and so
time.
it
And
made it
then,
very.
for the Iraq War, down about 15%, 82 days to recover. And then most recently, Russia, Ukraine, about a 7% initial drawdown and 23 days to recover. So,
Right.
the markets do tend to get, their footing back, but, there's a lot that can escalate and transpire over the past or the next couple of days.
Yeah, and even last June, right? Wasn't last June when Israel struck the
Hmm.
Iranian nuclear sites? I remember we had basically it wasn't even a day, because what
Yep.
you had is you had a pre-market sell off, and then during the day it kind of rebounded. So maybe this is starting to look maybe a little bit closer to that, right?
Yeah, it really will be, where we go from here. And I would say on days like this where, you're coming off a weekend of really big headlines, and we've got a couple days probably of big headlines ahead of us. And you kind of gotta sit tight and not try to be a hero. Um, Fall back on the plan, fall back on your allocation, and really see how this thing develops.
Yeah, even this morning, when you can look at where the fast money is reacting, and it was very, very typical. You saw oil spike this morning, even things like Lockheed Martin. I saw Lockheed Martin or RTX, which is part of Raytheon, right? They were both up about 4% last I looked. They're pairing their gains, so they were only up
Mhm.
like 2.5%. So when people try to jump on this stuff on Monday, it's usually
Yeah.
not a great trade. It's better kind of let this kind of sit, let it sit out for a couple days and see where things go, and see if things normalize.
I think one of the interesting things, though, that, and we've talked about this a lot over the past handful of months, was kind of the, people speculating about the demise of the dollar.
Right.
And, it puts things back in
And it's
context.
rallying,
You've
right?
got a major geopolitical event, and what happens? There's flight to safety, and, the dollar's ripping today.
Yeah, and some of the things that that caused the run up in emerging market stocks, they're the darlings so far this year, and they were all off today
Hmm.
as a result of a reverse trade, right? Because a lot of the gains in international markets were because of the dollar's been weak, and then just so far today the dollar has strengthening, and it's hurting those markets. So we'll see where that goes.
Yeah. Now, yeah, it'll be interesting. And, just thinking again, you've got that play back in place, and then, as we continue to look on what's going on in the Middle East, I think the next couple of days will be informative about um, what the what the regime looks like moving
Who's in charge?
forward.
Yes.
Right.
Yeah,
I
right.
mean, I think it's an open question right now, but there's a lot of levers that the Trump administration could pull in terms of lifting sanctions, if the new regime looks like it's going to be pragmatic. But it just depends. Right now, they seem pretty dug in.
Right. Yeah, it's hard to know who they're negotiating with, and in some ways you kind of feel a bit silly talking about the stock market, but that's kind of our job. Our job is not to cover so much the geopolitical issues, but the implications on portfolios
Hmm.
and our clients. So we have to look at that part of it. Certainly secondary when we talk about human lives that are lost. But if anything, we might come out if we can come out of it maybe a little bit globally safer. That would be positive. And then if we can get any kind of democracy, dare I say, in Iran, that I think economically we come out in a better place
Absolutely.
if that could happen.
Well,
Any other issues on the
no,
geopolitical
I
stuff?
would say, that just something we'll continue to monitor. And again, during times like this where headlines are frequent and emotions are high, it's just best to kind of sit back and reevaluate, take a moment and not try and react too aggressively or
Right.
emotionally.
Absolutely. So let's shift gears a little bit because we always go over in March. We want to go over a little bit of what's transpired in February, and I'd say in February it's a continuation of what kind of transpired in January. So far this year, what you're seeing for the first time in a long time, a big difference, and it's over 10% now. The difference between the performance of large cap growth, which is mostly negative, and mostly because the technology stocks are down a bit, and large cap values. So the dividend payers are up a lot this year, maybe up over 10%. As a proxy for that, I like to follow and a lot of clients own the Schwab. It's one of the largest Schwab dividend paying fund, SCHD, up 15.8% on a year to date basis. Where if you compare it to the Nasdaq's down about 3% on a year-to-date basis. And if you look at it from the sector standpoint, information technology, I'm looking at the sectors through Friday, down 5.5%. Financials took a hit last week.
Mm-hmm.
Financials are down 6% on a year-to-date basis. Then you have energy up 25% on a year-to-date basis, and some of the more defensive areas like materials up 18% year-to-date. Consumer staples up 16% year to date. Utilities up 14% year to date. So Dan, is it going to? What do you think? Is going to continue for the rest of the year?
I think that there's probably a pretty good bid in value. I think this level of outperformance though probably does not sustain, if I had to guess. You'll start to get to the kind of the inverse of what we had last year, where a lot of portfolios got out of whack with their growth exposures becoming, overly concentrated, and value really lagging behind. I think, quickly some of these value stocks will become a little too rich, and you'll have, a little bit of a broadening out of the market in that way. But for right now, I think this trend's intact, and a lot of it comes down to just uncertainty with AI, right?
Right.
February was an interesting month. There's always a different reason to be scared with AI. It seems like lately,
Yes.
it's
different industries take hits.
It's
pass around,
we won't have enough power, or we're going to have artificial general intelligence, or the companies are doing too much capex. The latest was, hey, software companies are all going to become irrelevant, and you really had software as a service in the month of February. I mean, those companies got decimated.
Right.
It was rough. So I mean, it's not often that you see the Dow Jones, outperforming the Nasdaq, but that difference was stark.
Absolutely. Yeah, I had a client ask me, and making a joke I think it was last Wednesday, saying, "Hey, he saw that wealth management, financial firms were were selling off on Wednesday and Thursday, and he said they're going to is your business kind of be replaced by AI?" And I said, it does remind me of 2000 when the internet first came around and the discount brokerage things became popular, whether it was Schwab or Ameritrade and everything. But people still, as they grow their wealth, still need to buy. They either don't have an inclination to do their own investments, or they just need clarity, and they need a partner. So I don't think we're going away anywhere soon. Although it rotates, you're right, from industry to industry. They get worried about the replacement of AI.
And, the one thing I do think certain aspects of many industries will become commoditized, right? But what has still been proven to be very difficult to replace is human interaction.
Right.
And I think that is an ongoing area of strength, and one of the, kind of bright spots, and at least for now, we can be, optimistic about. Who knows how good AI will be? Maybe at some point we'll have, Brett Bot. That'll be
Scary.
Yeah, more fun to talk to than either of us. But who knows? I mean,
here's one thing I have been saying to clients. So when you don't, it's different. It feels different than chasing the hot dot. Whether it's Bitcoin or these meme stocks that were going crazy. What were some of the meme stocks? I forget. There was
like
GameStop,
AMC and GameStop,
or even like in 2000s when we had the .com, like the pets.com, chasing those types of stocks, it doesn't feel great. And you always feel like you're a little bit late. But I don't mind, I think this is a great opportunity to reposition. And we're making sure that, because we have clients, if you just were equal weight growth versus value 3 years ago, you definitely have a tilt towards growth over the last few months because growth has grown more, right? So I think when you have the opportunity to reposition into a more conservative sector, like add to your growth stocks, it should be an easier trade. So we're making sure when we're having our client conversations, we're looking at that balance between growth and value to make sure they do have some weighting towards value, because some clients don't. It's probably not surprising that people have been chasing the Magnificent Seven stocks. When you look at their portfolio, they're just overweighted. So it's a great opportunity to move towards value.
Oh, yeah.
Or
I
dividends.
mean, that has not been the most popular phone call over the last handful of years to say, hey, we need to buy more dividend payers and you should really increase your exposure to Europe or emerging markets. And, outside of last year and the start of this year, that was, you were giving up some alpha in the portfolio by recommending that, even if it was in the pursuit of a better overall allocation.
Right.
But you're happy if you have it now, that's for sure.
No, you mentioned international. So let's look at a couple numbers there. One of the big ETFs, Vanguard VEU, it's the all world ex-US. So it's basically all around the globe, not in the US, up 11% on a year-to-date basis with a 1-year return of about 19%. Then some specific countries. I mean, I wouldn't chase these, but South Korea, they got an ETF for everything, but EWY in South Korea up 55% year-to-date, 183% on a 1-year basis. And a new one that people are chasing is South Africa. South Africa is ETF EZA up 18% year-to-date, about 96%.
Just a moderate rate of return,
Yeah,
a little bit
wouldn't
higher.
chase those. I wouldn't chase them.
No.
I wouldn't chase those specific countries. But what we should do is, I think it's still a good time, if you look at it from a valuation standpoint, to add a little bit more to international. And that's actually an area where, when we look at certain clients, I've had a couple clients that have said, I absolutely just don't want any European stocks. And we're trying to talk them into a little bit there, just to get a little bit of diversification there, because the valuations in Europe are still lower than the valuations here. So.
Yeah. Now, one of the other things I think, worth talking about a little bit that we saw in February was more kind of hawkish tone. We had a little bit of an adjustment where the Fed seemed slightly more dovish, and then inflation has proved to be sticky and persistent. And, now it looks like cuts are maybe backburnered toward the second half of the year, if at all. What do you make of that? And, as your thinking evolved on that at all?
Not to mention what's going to happen. I mean, we have the candidate. What are we going to do with the confirmation hearing? We know the last two Fed governors have taken a while. I think Powell took something like 80 days. Mm-hmm. It was I think 82 days. And who was before that? I forget. Who was,
Janet Yellen.
Yeah, for Janet Yellen. Yeah, right. About 79 days. So the last two Fed governors have taken a while to go through the confirmation process. And I would say, when clients say, well, how long do you think it'll take? I'll say, do you think it's more fractured now than it was then? That could take a while. So as we put a new Fed in place, and we still don't know. I don't think as of today, Jerome Powell has said, is he staying on as a Fed member even at this point?
If you feel confidently one way or the other, I'm pretty sure you can put a bet on that on Kalshi and the predictive markets. But I would tend to think, just based on their dynamic and some of the comments that he's made, I think there's a higher likelihood than in previous transitions where I do think you see him stay on for a period of time.
Could be.
It'll be interesting, but I think February was, in a lot of ways, some of the things were similar, right? Earnings season came out, a lot of positive surprises there, very strong again. A lot of the AI names, Nvidia comes to mind, extraordinary earnings report, but not a great month for the stock.
Right. Selling the news, really.
Yeah. So there's not a lot has changed, and at the same time, many things have changed, right? It's one of those weird months.
Yeah, when you look through, I was looking on Morningstar this morning. I have a watch list of hundreds of different ETFs and funds, and it was pretty amazing to go even into the domestic U.S. ETFs and mutual funds to find the S&P way down the list.
Hmm.
Because if you look at the S&P 500, it's about flat for the year. So you have so many funds outperforming the S&P, where in the past that was always up at the top, and a lot of that is because of the exposure of technology in the S&P itself, right? And if you look at things like RSP, equal weight, I think it's EQAL is the other equal weight. The EQAL is the Russell 1000
Hmm.
equal weight. So what they do with the S&P 500, obviously it's 500 companies, but it's market cap weighting, and weighted. And I think technologies was around 40% or 41% at the high point. So if you can take the same S&P 500 and equal weight all 500, you get much broader participation. That's what they do with RSP. Is dramatically outperforming the S&P. It's up over 10% year to date. So, and the S&P is near flat. So we'll see if that continues. But I kind of like that because it gives you can't live and invest with seven stocks giving you all the gains in the market, right?
Yeah, I wonder how you kind of square that circle, though, when you look at the underlying economy and you look
Right.
at, taking the AI trade out,
There's not a lot
the
of growth.
overall GDP was essentially flat to negative, right? So you really do have that K-shaped economy. And, if we get persistent pain, or investors get more focused on, which they did in February, like, okay,
Hmm.
you're doing all this spending. You did over, 500 million or $500 billion last year, projected to do over 600 billion this year.
Right.
If that's, when is that producing a return on investment?
Right.
Right. And if you don't have the tailwind from that trade, and the rest of the economy is basically sucking wind at this point, that's a little bit of a concern.
Another thing, don't underestimate how much of that movement, that rotation from technology into value is because of ETF movements. If you think
Hmm.
about it, because the technology, because the sector has been 40% of the S&P 500, if people are de-risking or institutions are de-risking a bit and selling a little bit of the S&P 500 funds itself, whether it's VOO or SPY, by that nature, the money is going to be sold from the Nvidias of the world, and
Hmm.
if they put it into equal weight, money's going to flow into some of the other sectors. So you wonder how much, because ETFs have been around for a while, but now they're really that's where the money's going. So that I think that dictates a lot of the performance of the various sectors where those asset allocations are being made between the passive equity funds as well.
Definitely. Um, Switching gears a little bit. So, another piece of news we had over the last handful of days. What did you make of Jack Dorsey's announcement that they were going to lay off 40% of the workforce at Square,
Yeah.
based on the efficiencies they've gained in AI? Is that, a canary in the coal mine for the larger, economy and corporate America, or is that more a niche kind of use
I
case?
wonder part of it. I think there's no doubt that there's use cases for AI. Okay, but I still think some of this is they're being a bit pragmatic, and I'll call it a little bit of like AI washing. Right, could be the new excuse to cut expenses. Right, but to just because we are seeing it across the tech space. In fact, on the TV behind us, there's some announcements there. So I wonder where that would go. And how about financials? I mean, last
Hmm.
week you had Morgan Stanley down 6%, Goldman Sachs down even a little bit more than that. I think it was looking at some numbers here, maybe a 7.5% decline. Same story, same fears, right? Is how much of it is going to be replaced by AI in the back office stuff? I don't think we know that answer, but I think we know, having worked at major banks through our careers, that they can use anything as an opportunity to cut costs, right?
It's just interesting. It's you know, when you look at a headline like that, it's just amazing how much the world has changed. Where at some point, if a company had laid off 40% of its workforce,
Right.
you would have serious questions about the viability of that company moving forward. And now, if you look at these pre and then post announcement moves in stocks where they're, they're making major layoffs. It's almost universally viewed as a positive these days.
Right. Yeah. It's too simple.
It
Right.
is.
It's too simple. But you said something earlier that I do want to come back to, because I think it is partially a smart way to think about it, is that it just doesn't, it won't go in a straight line, right? It's just not going to be, we're not going to be sitting here at the end of the year, I doubt, with dividend stocks that are now up 15%, or being up 45%, and tech stocks being down. I like Morningstar, and it's not even on the paid Morningstar subscription website. If you just go on the morningstar.com, they have a great a chart, or in the front of the page, it'll show you what sectors are overvalued and what style boxes are undervalued. And right now, they have large cap growth, which is mostly technology, as undervalued.
Yeah.
Right? Okay. And then they have the dividend, which would be, large cap value, and even mid and small value as more overvalued right now. So I think it's a lot of that is very short term. So and we've had a lot of head fakes. I mean, I don't know how many times over the last 2 years, for example, where we've had, this one's gone a little bit further, with where the Magnificent Seven stocks have underperformed, but they've come roaring back. Even I'm looking at some of the headlines today, like Morgan Stanley. Again, it's Monday, March 2nd. They just named Nvidia as their top semiconductor stock. So they replaced Micron, which has been running like crazy, and they replaced it with Nvidia and put a $260 price target. I think the stock is $174 or something. So that would be a heck of a rate of return. So don't sleep on Nvidia. Crazy last week what they did with their earnings. Their earnings were spectacular, and they came out. I think the stock was up. What was it up? The height after maybe like 4 or 5% the night of, and then before you know, it's down 6% again.
Yeah. Well, and that that Nvidia specific too is kind of a tale of all of their earnings releases, right? They quarter after quarter, they are just absolutely knocking the cover off the ball, and it is almost the exception that they have a positive day after that.
Right.
But the trend on the stock has been, clearly positive over time, tremendously so. But really, the other thing people have to think about is like pre-Liberation Day announcement versus now. You had the huge sell-off in Nvidia, but we're higher than we were before the tariffs were announced, but we're not like exponentially higher, right? We treaded a lot of water there for a while. So it's interesting. I was just looking at some of the gainers today. Expectedly, right? Palantir is doing pretty phenomenally well. Some of the energy companies, Northrop, Raytheon, they're holding back onto gains, but it's one of those days, right? All the major defense companies doing well, energy companies ripping, and then not unexpectedly, the leisure that you talked about, Norwegian Cruise Lines getting crushed today, Carnival Corp, Ford. So United Airlines, it's a rough day to be an optional expense.
Right. And that's it. But it's been if you were to look at the event and go back to Friday, and somebody told you the event's going to happen, it's pretty much gone by tape, right?
Yeah.
I don't see anything that's really unexpected as far as the market reaction. So it's really setting up to be more of a short-term reaction at this point. But again, we're dealing with what we know. The stock market tends to, trade ahead of the news, right? So from what we know, it should be a short-term event. We'll see what happens this week, because Trump even said, I think he's the
4 to 5 weeks.
4 to 5 weeks, right?
So one other interesting thing that I, again, for certain segment of our clients, this is, going to be not super interesting. For others, maybe more so. But I have been really struck over the course of the year, and even the last, handful of months, about the substantive decline in cryptocurrencies and Bitcoin in particular. And I just wonder, now that we've seen this pattern happen so many times, where you get tech sell-offs and Bitcoin essentially tracks the pullback, do you think we can put to bed that crypto is a hedge against the regular markets?
I
right?
wonder, the relationship. Now, I don't think it's a hedge against the markets anymore, but I wonder about the dynamic of gold versus, say, Bitcoin, for example, because I just hear because a lot of it's anecdotal evidence, but you see people invest more in the gold, with gold being the hot dot right now.
Yeah.
I think a lot of that crypto money, because now a lot of the crypto money has gone into the crypto ETFs, and now pretty easily you can go into the gold or silver ETFs. As long as that works, that satisfies the greed aspect
That
of,
contrarian.
or the
Yeah.
contrarian view. Since we're talking about speculation, I another topic I want to bring up, and you'd be a great person to ask about it, these betting markets and the poly markets that you can bet on everything. And I really think they need to, somebody, whether it's a Securities Exchange Commission, has to put a lid on some of these bets that are happening. You see, some of the news out where people made some pretty great profits. I know they had some profits about, Venezuela's leader coming out, right? The betting on that, and then people betting in the poly markets that the Iran supreme leader was going to be removed. And I think one of them, there's a couple different sites, right? I don't know if it's Poly Market or one of the sites at least banned where you can't bet against somebody getting assassinated.
Fascinated.
But the other one you still can, right? So what's the status there?
I just think, again, this is another, I look at the poly markets, I look at crypto, I look at them very similarly in the sense that, and just the rise of sports betting in general, right? Like they're
Right.
clearly scratching an itch for a significant portion of the population where, you're not going traditionally to the casino anymore, at least,
Mhm.
look at tourism figures in Las Vegas, closer to us, look at Atlantic City. It's just a
Right.
totally different, it's moved all online. Do I think it's healthy or good for us? Absolutely not. But it's clearly meeting, a significant demand. I just think there's such a need for regulation here. And to the extent that people can be really damaged by having this access. And it's also, to your point, betting on the assassination of someone, whether they're, your moral code says that they're a good or a bad person. I'm not sure that's a market you want to be involved in where you're betting on the demise of another human being,
Right.
as abhorrent as they may be, right? It
Right.
just seems like it's not a great thing for society.
Right.
But
It's not a great trend for investing that's a thing where, where you can bet on just a matter of everything. And I worry about the younger generation. Boy, I grew up in the days where we'd have like a football pool, and that was pretty exciting to bet on a couple football games. I can't imagine having a cell phone in my teens or 20s where you could bet on anything you want to do. So that's not a good thing. And if these well-reported big wins where a couple people made over $1 million on this trade over the weekend betting on the Iranian leader to be assassinated, somebody's got to lose. There's another side to all those trades as well.
when I was
right?
looking, I just pulled up while we're chatting here, but you're looking at, what are the trending bets for, with Iran right
And
now.
this is in Poly Market?
This is on Kalshi. So
Kalshi,
you've got
yeah,
who will
right.
be the next supreme leader of Iran. You've got Arafi as the top bet at 26%. They're offering 3.66 times leverage on that bet. Versus Hassan Khomeini at 4.98 times. But
So
it's
you
only,
can bet on this stuff.
yeah,
Crazy.
and to me, it's just, again, this is not investing.
Right.
This is
Right.
betting. This is
Yeah.
speculation, and I do think just societally, this is not the direction we should be moving. But
Right.
call
So-
me old school.
So let's close it out with some thoughts on where investors should be positioning, and I think we've kind of made a little bit clear in the podcast this month is that kind of like the trend again of large cap value. We don't want to just overdo it. We don't want to sell all your tech stocks and put all your tech stocks into dividend stocks, but there are some great options. We have a great portfolio manager, Catherine Avery, who does. I don't know how she's doing year to
She's
date.
doing very well, close to 9% year to date. She just got manager of the decade from Zephyr in the dividend space. So
And
yeah,
her dividend's been it's over 3.5, right?
yeah, so substantial
3.5% dividend.
yeah,
so.
yield and performance play. But there's some great managers there, some great ETFs. Just all these things in moderation, right? You got to fight the hesitation to just, try and reorient your portfolio entirely. But this is why we consistently preach having a diversified portfolio where you're having different styles, different market capitalizations and different geographies represented within your portfolio, you're never going to chase exactly what the market performance is doing, but it's going to provide ballast when different parts are zigging and zagging, which we're seeing right now.
But it's a great time to just look at your portfolio and say, do I have, small caps are up over 10%. That hasn't happened in a while. Do you want to have, 5 to 7% in small or mid caps? I think the answer is yes. These are companies that could have a higher growth rate. Do we want to have money in international? The answer is yes. It's a question of the percentage in international. Do we want to have a mix now between value and growth? The answer is yes. For most of our clients, they do. Even going back to UBS, they had QGARP and dividend ruler. A lot of our clients had equal parts of both. But then when I look at portfolios, a lot of them now, the QGARP is much larger than the dividend portfolio. So over time, I wouldn't do it today because, right now it's probably see a little bit of a swing back to growth at some point. But we need to work over the upcoming months to kind of equalize that. So we're spreading it out.
And to the same way where we were saying, last month or 2 months ago, or even last quarter, saying, hey, growth is maybe getting a little heavy in portfolios. It might be time to look elsewhere. There will become a time in the near future, if this trend persists, where growth is cheap.
Right.
With certain names already there. The broader sector, I would say, is still pretty expensive relatively, but again, if we see this continued trade, there will be a time where, maybe you're getting an unexpected phone call and saying, hey, these AI stocks are now on sale.
Right.
So it just, you got to keep an open mind, be nimble, and have a portfolio that makes sense in the context of your bigger financial plan.
And the last trend to think about, and it's a continual trend that we've been talking about for clients, money market rates continue to go lower. The Fed's been active. Most of the money market rates are now below 4%. They had been, above 5.5%. So it's something to look at. Perhaps, we could even in the bond market lock you into something maybe more of a either shorter intermediate term ETF to kind of do some yield pickup there. Just something to be mindful about it. When that 4% is an important number because when you get below 4, I always look at when you factor inflation. If inflation's about 2.5%, then you factor in your tax rate. At a 4% yield, you're really not outproducing taxes and inflation. So there might be some action oriented there.
Yeah, I think so. And naturally, cash, that was an easy trade over the last handful of years, was
at 5%.
Take no volatility, earn an easy 5%. But the markets are changing, and you've got to be a little bit dynamic in that way too.
Okay, good. So, well, thank you all for tuning in. Again, I feel like in so many ways, our clients were preaching to the choir because they give it back to me. I talked to a client this morning. He says, I know I'm well diversified and I know the answer is I shouldn't be doing anything. So I'm like, well, then you're telling me, but they've heard the advice and they don't react to the news cycle. So thank you all for joining us. Appreciate it. And then we're going to, just for the clients out there, we are planning, we're going to do another webinar maybe on Friday of this week to kind of address, because again, we're sitting on it's Monday the 2nd, just to see how things go over the next couple of days. So I appreciate your time and your confidence. Thank you.
Thanks, everyone.
Cornerstone Private Wealth is an independent financial firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Cornerstone Private Wealth Partners provides all investment advisory services through Concurrent Investment Advisors, LLC, an SEC-registered investment advisor. Concurrent Investment Partners, LLC, DBA, Cornerstone Private Wealth are not affiliated companies. The items discussed are the views of the presenters and not of Concurrent Investment Advisors, LLC. The information provided in this podcast is for informational and/or educational purposes only and is not in any way to be considered investment advice nor recommendation of any investment product. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be more or less than originally invested. Concurrent Investment Advisors, LLC and Cornerstone Private Wealth is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. Please consult with your attorney, accountant, or tax advisor based solely on your individual circumstances.